In this recap video, I'm going to go over my trading journal for January to see what I did right, what I did wrong, what strategies I traded, and which ones either made or lost money. It is so important to go over your trading journal in depth at the end of each month to see where you can learn from your mistakes and improve. And I want to make this video so you can learn from my mistakes as well. So here, if you look at my trading journal, you can see that I use TraderSync to journal all of my trades. And up at the top, you can select different criteria to filter out which trades you want to see. So my total return for the month is about $4,000, which isn't bad. If you annualize that, that's about $48,000 a year, but it's not great, and I'll show you why in a minute. My win rate for the month is around 57.7%, and my return on winners is 22,000, but my return on losers is just over 18,000. And that's kind of where you can start to see that there's a little bit of a problem for this month. To have 22,000 in winners and over 18,000 in losers for the month just jumps out to me that there must have been some huge losses that wiped out a lot of my winners. The next thing that I start to notice is when I scroll down, you can see that there's a ton of trades that I closed in January, and I think there's about 52 in total here, and that is way higher than my average trades per month. And I just know from past experience that when I overtrade, I tend to severely underperform. Some of these trades might have been opened over 2 or 3 months ago, and some I intended to hold longer than January. But with the market being so overstretched and some key economic events coming up, I decided to close a lot of trades and reduce my margin. Here I have each strategy listed that I used, and you can see that the bear call spread netted $8.95, the bear put spread lost $23.28, the bull put spread netted $12.35, the bull put spread extreme lost $1,100, the bull call spread netted $7.14, covered calls collected $9.31, diagonal spread about $1,300, just a straight long call lost $8.39, the bullish synthetic lost $9.85, and straight shares netted $41.17. For a total P&L of about $4,000. So now looking at this breakdown, there's a few things that jump out that I want to dig deeper into. One's going to be the bear put spreads and the bull put spread extreme. So if we go back to the trading journal, I'm going to start scrolling down and looking for large losses. And the first one that I want to check on is this one on Humana. This was the bull put spread extreme that I was talking about that we had an $1,100 net loss on. Up at the top here, you can see that this trade lost $1,690. And if we scroll down, I have a screenshot of the charts. On the charts, you can see a strong support line that's been tested multiple times and held up. And right here where I have the O marked is where I open the strategy. This strategy is a type of credit spread that has a very wide profit zone and a very high win rate. And I entered the trade on this candle right here. To enter this, I sold a put around 400 and then bought another put at 395. So as long as the price stayed above this level before expiration, I was set to collect the full premium. But as you can see, a few days after I entered this trade, a bad news event came out and the stock gapped down tremendously. Price got down below my short strike price of 400 and was just hovering around that level for a few days. Now, another mistake that you can note on this trade was I entered it when earnings was coming up. So I had to make sure that I closed this trade before earnings, which I closed just the day before. And thank God I did, because the stock then proceeded to gap down even more. And this trade, I think, had a max loss of $4,300. So it could have got a lot worse than it was. So if we go back to the journal, we can see that this trade on Boeing was another large loss. So let's look into that one. So on this trade on Boeing, you can see that the stock was on an uptrend over here, consolidated for a while, tried to break out, and then failed. So I know there's all kinds of stuff going on in the chart here, and I just leave all these indicators on for my trading journal just to review context. But if we zoom on in here, I'll show you the reason why I entered the trade. So after this failed breakout, you can see that the stock reversed into a short-term downtrend. Price then hit a bottom and started coming back up. And it got back up to the 200 and the 150 are both together here. And it also closed outside of the Bollinger Bands with a bearish pin bar. And that was where I entered the trade on thoughts that this 200 and 150 would prove to be resistance. The first day after opening, it looked like the trade was going to work out. The second day, it still looked okay. And then the third day, you can see that price shot way up And this was also on a news event. I can't remember what exactly it was. One of the big airlines announced that they were buying a ton of Boeing planes or something of that matter. And you can see that my call credit spread short call strike was right at this level, which as soon as price closes above that level is where I need to cut loss on the trade. And after the first few days of not closing the trade above my stop loss, it already had lost so much of its premium that I figured at that point, for the extra $100 or $200 that it was, I might as well just leave the trade on in case price ended up reversing back down in hopes to recoup the losses. But as you can see, price just skyrocketed from that point on, and that trade ended up losing the max loss. In hindsight's 2020, I mean, at the time, I really did not expect price to just skyrocket like this. But either way, I did not follow my rules, and I did not cut loss at my short strike, which would have only ended up being maybe a $300 or $400 loss. Instead, it was well over $1,000 that I didn't have to lose. Another very similar trade and mistake was this one on SPY. It netted a loss of $1,185. And if we look at the chart, it's pretty much the same story. This trade was another bear put spread, and I entered it on this strong resistance line going back to midsummer when the S&P 500 corrected, and price came back up and consolidated on this a little bit, and the market at the time seemed very overstretched after all this pain that we experienced through the late summer. So as a hedge, I entered a bear put spread. You can see it wasn't even a good entry on this strong bullish candle. It would have been much better to enter on this bearish engulfing candle here to have some sort of confirmation in the trade. After just a few days, you can see that price came up above my short strike here. And for whatever reasons at the time, I did not close the trade once again. Price just looked so overstretched to me, I figured the market had to correct. And the next couple days shot way up. And by that time, the trade once again had lost so much premium that I figured, well, at this point, I might as well just keep it on and use the trade as a hedge in case the market does pull back again. And this is just one of the risks that you're going to have to be willing to take if you're going to counter trend trade. You can see that the S&P 500 has been on a very strong uptrend, and trading against that is just a lower probability setup. But it still could have been a good trade to take. And if I would have just closed it at my stop loss, I would have only lost $400, maybe $500. But instead, the trade lost over $1,000. Now back to the journal, scrolling down, I can see that this trade on Tesla was my biggest loss for the month. So let's dig into that one. This trade lost $2,200, which is pretty much right at my 2% max loss from my total account size. You can see here that Tesla's been consolidating for quite some time, and the range just keeps getting tighter and tighter. And it's also been severely underperforming compared to the Magnificent Seven. So price is bouncing back and forth, tightening up in its range. And then you can see it got real tight here, trading around this 240 mark for over a couple weeks. And then right at this candle, you can see that it had a pretty good breakout, and price shot up and hit this massive resistance line, which people are calling this like the mother of all trend lines on Tesla, because if you zoom out onto the bigger picture, it goes back like 2 or 3 years. So price came up to that trend line and resisted it with this huge bearish engulfing candle. And once it got back down to this 50 MA, I decided to open a more speculative position on this doji candle. For this trade, I decided to use a bullish synthetic spread because I just wanted to play a short pop in a stock and then take quick profits on it. This 50 moving average is not the reason that I entered the trade. I entered it on a demand zone. So once I see price consolidating for a long time and then break out with strong volume above that, I now deem this as a demand zone, and I look at it as a higher likelihood that when price comes back down into the zone, it will find these buyers again and bounce out of it. And note that with this strategy, I'm not trying to play a breakout of this trend line. I just want to catch a few strong bullish candles off of this demand zone. Even if the trade only got up into this area, it would have netted a pretty large profit. And the next day after I entered it, the trade looked good with this nice bullish candle. I think it was up a few $100s. But then the next few days after that, price kept coming down. Then you can see we had a bullish pin bar on this 200 MA, making the trade still look good. And at this point, I think it was still above my cut loss, which is around $228 per share. But then the next day, price gapped down and closed way down here, which is where I ended up closing the trade for the $2,200 loss. So looking back on this trade, the only thing that I probably would have done different is instead of having my stop loss down here, I should have maybe used this 200 moving average, and as soon as price closed below that, I could have got out of the trade. I think even at this candle, my loss was around $800 or $900, which is way better than $2,200. So two other large losses that I want to bring up is this one on Rivian, which was an $1,165 loss, and this one on Solar Edge, which was a $1,208 loss. And I won't go through them like the Tesla trade because they're very similar, but there's a very important lesson to learn from the Tesla, Rivian, and Solar Edge trades here. They are all my largest losses. So the big problem with these three trades, if you're not familiar with the stocks, is that they're heavily correlated and they're all opened around the same time. So not only are Tesla and Rivian both EV manufacturers, Solar Edge, Tesla, and Rivian are all very sensitive to interest rates. And the macro environment lately has been all about interest rates. So basically, as soon as the market started pricing in that we're not going to get our March rate cut, these three names started selling off heavily. Not only does it suck to have a large loss on one trade, but now the chances of you losing all three trades are very high. So now after going over all the mistakes that I made, let's look at some good trades. This trade on CVS was a nice trade that netted $1,866 for a 292% return. If we were to zoom out on this chart even further, this support trend line down here goes way back and it's been tested multiple times. And price got back down onto this and consolidated in this range for a while. If we zoom in, you can see it's been tested multiple times, even in the most recent time frame. For this trade, I also used a bullish synthetic spread, and this was actually meant to be held over the longer term. You can see the trade immediately worked out and skyrocketed up, consolidated for a little bit, and then shot up again. And then on this candle here, this day it was up, I don't remember, well over 5%, I think. And it was nearing this supply zone up here. And even though this trade was meant to be held much longer than this, the context of the charts was telling me that I better just take profit and close it, which turned out to be almost near perfect timing because I don't have it on this chart, but price ended up gapping way back down to near the 200 moving average on the same news that Humana trade lost on. And I actually bought some shares when it got back down to here. And if it continues to hold this 200 moving average, I might even look at re-entering this trade for a bounce. But overall, this is just a solid trade using long-term trendline support. Another good trade using the same strategy was on Palantir, netting a $1,210 profit. Ever since this whole AI craze started, Palantir's been on a very strong uptrend. And if we zoom into this, you can see that it started to form this trendline support, which has been tested multiple times. And when price broke below the support and then closed back above it, I entered it on this candle right here. And you can see that for about over a week, it just kind of hung around the trend line. And then on this day, it skyrocketed up and hit its 50 moving average. And I closed it right at the dang near top of that for a nice profit. And with this strategy, this is really all you need is 1 or 2 days of strong bullish momentum, and the trade's going to be up significantly. But it also goes the same for the losses on it. You need to cut losses quickly with this strategy and take profits early. It's just what I found out works best for me. To show you a different strategy, we'll look at this trade on Apple, which netted $1,714. And this trade, I used a bull call spread. And you can see that Apple's been on a really strong uptrend for a long time. And if we zoom in, the 200 moving average has been strong support for Apple. It's bounced multiple times. And once we got this bounce with this huge bullish candle, I opened a bull call spread. I think this trade short put was around 195, which would be the max profit level for this trade. After these 3 days of strong momentum and gapping up, I decided to take profits on the trade. And if we were to look into the future, you would see that Apple did in fact end up closing up above this line, which in hindsight sucks looking back, knowing that this trade could have made over $2,000. But you never know. I mean, price could have just as easily shot right back down and I would have gave up all them profits. So I guess you just can't complain when you do have profits and you can't beat yourself up over the shoulda, woulda, couldas. So some other nice trades I had were on Disney for about $1,000. That was using a bullish synthetic. Adobe for $460. That was a bull put spread. American Express for $729. That was a bear put spread. Applied Materials that was a Bullish Synthetic spread for $8.25. CVX was a bear call spread for $4.70. And my big winners for this month were just on straight shares. And these are just shares that I've been holding for a long time. You can see my entry price is only $114. I picked them up back in the bear market of October 28th, 2022. And really the only reason I trim these shares is to reduce margin. With the market being currently overstretched like it is, I want to reduce my margin down to zero. So if the time comes that there is a correction, I have some dry powder that I can deploy. And with margin rates as high as they are right now, I don't want to be paying interest on shares that are dropping in value. Like I said, hindsight's 2020. Meta just reported earnings a few days ago, and now the shares are up above $4.50 per share. It skyrocketed up above 20%. So yeah, I definitely let some profits slip on that one, but you just never know. They could have easily reported bad earnings, and it could have been the start of the S&P 500 pullback. So after reviewing my trading journal for January, there's 4 main lessons that I would draw from this. The first would be don't overtrade. As you can see, I had a ton of trades closed in that month, I think 52 in total. And overtrading can have a lot to do with your psychology and where your mind is at the time. It could be that you're itching to put on a trade, which usually results in lower quality setups and higher risk trades. It could even be a revenge trade, which is opening a risky position to try to recoup losses from a losing trade. From past experience, I found that overtrading just tends to produce poor results for me. The second lesson would be opening too many correlated trades, as I showed you with the Tesla, Rivian, and SolarEdge trade. Not only are Rivian and Tesla both EV manufacturers, but they're all three heavily sensitive to interest rates. And in this current macro environment, interest rates are the talk of the town. The third lesson takeaway is to be very careful if you're going to try to short a strong bull market. If you're going to try to trade counter trend and call a top somewhere, just know that it is a much lower probability setup trying to go against the market and counter trend trade. Also, the market tends to go up much more than it goes down. The fourth, and I would argue the most important lesson, is to respect your stop loss. That is the whole point of the stop loss. It is to invalidate your trade, and once it is hit, you need to close the trade. As you can see, I gave back thousands of dollars in profit because I held on to the trades thinking that the market was going to do something different. Now I'm still lucky that when all the dust settles, I'm still up $4,000 for the month, and I can go back into my journal and review all these lessons and improve my trading each and every month. Please let me know if you enjoy these trading recap videos and find value in them. If you do, maybe I'll try to get one out at the end of each month. And if there's anything else you'd like to see in these videos, just let me know down in the comments and I'll do my best to get it out. But until next time, good luck trading.